Hi guys, so a while ago on Instagram I asked my followers to give me their top beginners investing tips that I could share on a video. Now I had quite a lot of responses, but pretty much everything was of a similar nature, and I've worked through it now and grouped things together. It's pretty much managed to be whittled down to a basically top 10 tips for beginner investors. So I thought it would be good to share with you. I know there are a lot of people who are completely brand new to investing or who are thinking about investing, and I thought this might be quite useful. So if you have any tips outside of this, please do put them in the comments below because they might be useful to people who are just starting out. Otherwise, I'm going to jump straight in. So tip number one is that you don't actually need a lot to start investing. I think a lot of people have the misconception that you need a lot of money to get started, but with all the platforms that are available these days, you can start investing with such a small amount of money. You know, places like Free Trade and Trading 212, although they're obviously not accepting new clients right now, but Free Trade are, you know, you can invest from as little as £2. Don't see it as something that you need a lot of money for. Just get started. And the other thing was, even if you do just get started with small amounts, it's better than waiting until you have bigger amounts, because the magic of compound interest, and a lot of us sound like broken records when we talk about it, but you need to give your money time to get those returns. So it's better to start with smaller amounts than hold off and wait. Tip number two is probably one of the most important ones in my opinion, and that is don't panic sell when the market goes down. Essentially what you want to do is just pay in every month and leave it, forget about it. Don't be checking it every day, don't be panicking that it's going down and you might want to sell, because until you've sold, that is a paper loss. So if you think about what happened when the markets crashed last March, so many people would have probably panicked and sold out at that point. And what's happened now? It's gone back and is higher than it was back then. So all those people would have like cashed in those losses, whereas if they'd held on and waited until now, they would be far better off. Tip number three, if you are a beginner investor, is do not try to time the market. So many people try to time the market, try to get in at the right time and go, oh, this has dropped, I'm going to get in now, or, you know, I think this is going to happen, I think this is going to happen. You cannot time the market. Just put in a little bit every month and leave it, going back to the previous one. No one can actually predict the market, and people try and sometimes they get lucky, but the market is completely unpredictable. And there have been studies that show that people who just consistently dollar cost average and put in smaller amounts on a more regular basis outperform those who try to hold off and time the market. Tip number four is another really important one that came up a lot, and it is keep it simple. As a beginner, you need to understand that you do not need to invest into individual companies, and you can build wealth just through one well-diversified index fund. So literally just investing into, for example, the S&P 500 or one of the Vanguard other funds, you are getting exposure to the biggest companies in the world. And with the S&P 500, you've already got 500 companies in there. That is so much diversification. Have one index fund, maybe two or three. You do not need to have 50 individual companies in your portfolio. Also, if you do want to learn and maybe invest in individual companies, then maybe the thing to do is just to get started with index funds first, and then do your learning and your research and becoming more sort of comfortable with the individual company investment. Tip number five only came up a couple times, but it is a really important one, and I think I see it in my comments sometimes or in my DMs where people don't quite realize this, and that is that you can only have one stocks and shares ISA per tax year. Or rather, the better way to phrase that is you can only open and contribute to one stocks and shares ISA per tax year. So the example I give is, you know, with me, last year I had my stocks and shares ISA with Trading 212, and this tax year it's with Money Farm. So I still have my Trading 212 ISA from last year, but I can't add any new money into it. Okay, so I've now opened the Money Farm one this year. It's the only one I can actually contribute to this year. So I can still hold my old ones, but I can't contribute new money to them. Tip number 6 is that good news about a company doesn't always mean that the price will go up, and vice versa. Yes, usually headlines will impact the share price, especially when negative, but it doesn't always mean that that will happen. So don't jump on companies, especially after the news has already broken, because that will already be priced into the price at the moment. And yes, it might go up even more, or it might go down even more. But again, it goes back to that whole point about the stock market being unpredictable. Tip number 7 is don't jump on the Reddit trends or just the trendy stocks that everyone thinks are going to make them millions of pounds, because whilst you might get lucky and be one of the very first people that do it, generally by the time it becomes a hype and a trend, it's a bit late. And usually the people that get in near the end are the ones that lose out, because at that point all those initial people will sell out and the stock will crash, and then you're left in the massive negative position and there's not much you can do about it. So I learnt that the hard way in one of my positions, and that's okay, because I knew when I got in that this particular stock was extreme high risk. So I expected that I could lose everything, and it's gone down 80% now. 80%, it's insane. But yeah, don't jump on trends just because you think they're going to make you millionaires. Tip number 8 is the thing that you will see on every single advert for investing, and that is past performance is not an indicator of future performance. You should not be buying into a company just because it has performed well in the past. Like, that should not be your only reason for buying into a specific stock. And similar with the stock market, you know, just because it's gone up on average 8 to 10% per year as a whole, it doesn't mean that that will continue. It might get better, it might get worse. It is a little bit unpredictable. So don't just assume that because a certain stock or the stock market generally has performed a certain way in the past, that it will continue to do so in the future. Tip number 9 is your capital is at risk. It is really important to reiterate that. And whilst the likelihood of losing all your money if you invest into index funds like the S&P 500 is very, very small, if you invest in individual companies, it is a much higher risk. But you also need to consider that if you invest in the S&P 500, if all those companies' values go to zero, we are going to have much bigger problems. And I've seen this on Instagram lately, and it's very, very true. You will not be worried about losing your investments if that happens, because we will be in such a world crisis if that happens that, yeah, you really won't care. But you should not be investing money that you are not prepared to lose, even in the S&P 500, because whilst the likelihood is that you won't lose it fully, you don't know how much it could potentially go down. And you know, there could be a thing where for the next few years there is a massive market downturn and you are in the red constantly for 5 years, and you know, you don't want to have to take that money out. Which leads quite nicely into the final tip, which is essentially don't invest money you might need in the short term. So try to aim for about a 5-year plus horizon. Obviously the longer the better, but like I said, you do not want to be forced to sell at a loss, because if we enter into some sort of recession where the markets just crash and stay there for 5 years, are you going to be happy selling at a 50% loss? You want to be in a position to hold until it goes back up again. Obviously, do remember that I'm not a financial advisor, and I am just telling you these things based on my own experience and also the things that my followers said on Instagram. But yeah, hopefully this was useful, and let me know if there's anything, if you aren't a beginner, that I've missed in the comments below. Otherwise, I will see you in the next video. Bye.